gold at $5,000, silver at $121. Those were unsustainable. Silver's come down to $58 as we speak.
You mentioned $30 silver, Jeff. I know people will get mad.
Deepest recession in the post-war period. Oil prices had quadrupled. You're looking at the gold and silver markets, China and India are extremely important. On a global economic and political basis, you have to have a free economy and a free market. That will cause people to lose money as well as make money. Now we have the crypto and AI bubbles, and they will burst and people will lose trillions of dollars. And in the United States, and to a lesser extent in Europe and other countries, you look at the seasonality of these markets and you look at what's happening with ETF purchases and sales, and you say, okay, we're not at the bottom yet. So the Iranian war is going to continue to be a problem, continue to disrupt trade in the Gulf region, and it's going to continue to cause long-term political and economic issues. It's going to be positive for gold and silver. Gold at $5,000, silver at $121, those were unsustainable. But if you look at the dynamics of the markets and you see the extent to which investors have a tremendous amount of money that they are in cash with, earning 3% if they're lucky, or 4%, and they're saying, where do I put my money? That suggests that when gold prices come down, they're $4,070 as we speak, they're probably going to stay far above previous levels. And, silver's come down to its $58 as we speak. It can come down, but it's probably not going back to $10 or $15, which is where it was 8 years ago. It's probably going to come down and stay somewhere above $30 for the foreseeable future. And gold too, and the stock market too. So there's this sort of revaluation of financial assets that reflects this tremendous pool of investable money looking for investments. Now, a lot of that money's been going into these really speculative things like cryptos and AIs. Our view is that both of those things are likely to experience multi-trillion-dollar losses in valuation at some point. And when that happens, you'll see money coming out of there looking for new homes. And that'll drive down interest rates. It'll drive up gold and silver. And it will benefit companies that actually make stuff.
Yes, so you mentioned $30 silver, Jeff. I know people will get mad when they hear that. So would you be surprised to see prices reaching that levels, or so I suppose what I'm asking, do you expect silver to get to these levels, or would that just be
$30?
Yeah.
Markets celebrated the pullback, but smart money often treats corrections as inventory, not surrender. Jeff Christian notes speculative capital parked in AI and crypto could eventually rotate elsewhere, yet few ask where trillions actually hide while waiting. That distinction matters because capital rarely disappears, it simply changes destinations. Investors focused only on price may miss the structural flaw beneath precious metals. Next, Jeff Christian exposes why institutional cash reserves could become gold's strongest catalyst.
Yeah. We think that the silver price probably stays above $50 for the rest of this year. Our expectation is that the price is testing $58 right now, $55, $50. We think it probably stays above $50 over the next couple months and then moves sharply higher over the rest of the year. So we're looking, the year-to-date average price for silver is about $70, and our projection for the average price for the full year is around $70. So insofar as the price is 58 right now and it has been trading below $70 for several weeks, our expectation is that the price is going to rise and rise significantly after August. So the final 4 months of this year, sort of a replay of last year. And the same is true for gold. And then we say, well, where do they go after December? And for the price of silver to fall back to 30, you have to have an economic and political environment which is much less risky, much less uncertain. You have to have greater certainty of better economic conditions than we have right now, or than we have had in the last 20 years. You know, and we don't see that on the horizon because the major long-term structural problems, politically, economically, monetarily, financially, socially, they're all still in place. And some of them have gotten worse. They haven't gotten better. So, for me, for a long time, people from after 1980 would say, Jeff, do you think that gold prices will get back to 850? And I would say, look, when gold got to $850 in January of 1980, we had 14% inflation, 21% interest rates.
The calendar often matters more than the headline because seasonal turning points repeatedly catch retail investors off guard. According to Jeff Christian, silver's weakness looks more like a pause before stronger late-year momentum than the start of a collapse. The overlooked issue is that today's structural risks remain unresolved despite improving headlines. Waiting for perfect certainty often means buying after institutions already reposition. Next, Jeff Christian reveals why history makes a sustained return to $30 increasingly difficult to justify. Every major
recession in the post-war period, oil prices had quadrupled. You had an oil embargo. You had U.S. hostages in Iran. You had Soviet troops in Afghanistan. If you can give me that political and economic environment, I'll give you 850 gold. In 2000, I gave a speech and I said, we think that for the next several decades, not 1 or 2 years, but decades, you're going to see a more hostile economic and political environment than we saw in January 1980, and gold's going to blow right past $850. And for 26 years, we've been right. You have to convince me that we're not going to see as hostile of an economic and political environment in the future for me to say, oh, yes, silver's falling to $30 or gold's falling to whatever, $2,000 or $3,000. I don't see those improvements on the immediate horizon.
Yeah.
So convince me that I'm wrong about the state of the world, and I will grant you lower silver prices.
I don't think I'd be able to do that, Jeff. How important, Jeff, is China for this whole commodity complex? Because even for gold, I was talking with Michael Howell not too long ago, and he was sort of emphasizing the correlation between Chinese liquidity and gold price, meaning that there is a very interesting correlation there. Do you pay attention to China when analyzing gold and commodities?
I pay a whole lot of attention to China, and I also pay a lot of attention to India. I mean, those are two of the most dynamic markets. They're the biggest markets. Those two countries are the biggest markets for gold and silver.
Gold cycle has been fueled by instability, not optimism, and today's risks remain remarkably persistent. What Jeff Christian is highlighting is that investors expecting dramatically lower precious metal prices must first assume geopolitical and monetary tensions suddenly disappear. That assumption deserves far more skepticism than mainstream forecasts receive. Protecting purchasing power begins with questioning whether today's risks are truly temporary. Next, Jeff Christian unravels why China and India quietly shape the future of global precious metals demand.
So in and of itself, just looking at the gold and silver markets, China and India are extremely important. But beyond that, on a global economic and political basis, China and India are extremely important too. And China in particular, because it has a managed economy, the difference between China and India is that China has a managed economy and is controlled by a communist party. And India has this social, it's a democracy that looks like a rugby game. And the amazing thing about India is that it's doing so well, given the fact that it still has a democracy that looks like a rugby game. Now, Modi has clamped down on a lot of stuff, and that has helped. But just looking at China, China has allowed itself to say, look, it's not just the last 80 years, it's the last 400 years that we really had a lot of economic constraints. And we have to avoid those economic constraints. And because we have a managed economy, we can try to avoid those. And the Chinese government says, in the United States and to some extent in Europe, there's this whole concept of creative destruction. And, it's like, well, you have to have a free economy and a free market, and that will cause people to lose money as well as make money. And you'll have these periodic spasms where people lose trillions of dollars. So we had the internet stock bubble burst in 2000, 2001, and people lost trillions of dollars. And then we had the housing and collateralized mortgage obligation bubble burst in 2007, 2008, and people lost trillions of dollars.
The biggest economic experiment isn't happening on Wall Street. It's unfolding inside competing economic systems. Jeff Christian's argument suggests China's managed approach aims to reduce destructive boom and bust cycles that Western markets often accept as normal. Whether that strategy succeeds or not, resource security has become a long-term national priority rather than a quarterly trade. Investors ignoring that shift may underestimate future commodity demand. Next, Jeff Christian reveals why China's resource strategy extends far beyond mining profits.
And now we have the crypto and AI bubbles, and they will burst and people will lose trillions of dollars. And in the United States, and to a lesser extent in Europe and other countries, they say, okay, that's the cost of progress. The Chinese government says, let's try to avoid that. And that means more cautious growth, more careful growth, more central planning. And they've succeeded. And they've also had, because they have that central planning and management of their economy, they're able to say, all these other countries are saying, I don't want you mining in my country, but we understand that all of these raw materials are central to economic progress. And insofar as other countries don't want to mine it, fine, they can buy it from us.
Right.
So China is very, very important.
And would you say that in order for us to have a next big move in gold, we would need to see liquidity go a little bit higher in China as well, or you don't think that's necessarily required?
I don't think it's necessary. I think the liquidity's there. It's people, people did very well from September through January in gold and silver and platinum and palladium and copper. And then some of the smart people took profits, and those profits are sitting there waiting for a sign that the prices have bottomed out and are going to rise again. And you look at the seasonality of these markets, and you look at what's happening with ETF purchases and sales, and you say, okay, we're not at the bottom yet. But when there's a sign that we're at or close to the bottom, there's a tremendous amount of money we think that will pour back in, because there is tremendous amount of liquidity in the global economy, despite what it feels like sometimes.
Liquidity rarely disappears. It simply waits until confidence returns, despite headlines claiming capital has vanished. This is where Jeff Christian's thesis shifts from supply toward investor psychology, arguing sideline money can rapidly return once markets sense a bottom. The contradiction is that fearful sentiment often peaks precisely when liquidity remains abundant beneath the surface. Patient investors benefit from recognizing that difference before momentum changes. Next, Jeff Christian exposes why available liquidity may matter more than central bank stimulus.
It's bad. So the Iranian war is going to continue to be a problem. It's going to continue to disrupt trade in the Gulf region and through the Straits of Hormuz. And it's going to continue to cause long-term political and economic issues for the United States government and U.S. economy. So it's going to be positive for gold and silver, if you will. Yeah. The economies worldwide have been doing pretty well. And as we speak today on the 15th of July, you saw like a 4.2% GDP figure coming out of China. The United States was about 2.1, I think, was the most recent figure for the first quarter. So economic conditions have been plugging around along halfway decently, we do have an inflationary issue, but there are signs of weakness. There's weakening in the employment markets, not only in the United States, but in other countries. China continues to have a number of economic issues, Europe, Canada, the United States. There are signs of economic weakening while inflation remains problematic. Now, we had some good CPI figures yesterday for the United States and PPI for today for the United States, but those are figures that are primarily reflecting a spike in oil prices due to the United States attack on Iran, and then a decline in oil prices in June relative to May during the period of time when hostilities lessened, and people thought maybe there could be a political or diplomatic settlement to this. So that's probably the transient reduction in inflation. Same way that the spike in May was a transient spike in inflation. Inflation remains a problem. Long-term economic growth remains a problem.
A single softer inflation report can distract investors from much larger structural pressures building underneath. Jeff Christian notes temporary energy swings may improve headline inflation, while persistent economic weakness remains unresolved across major economies. Markets frequently celebrate short-term data even as long-term purchasing power continues eroding. Wealth preservation depends on separating cyclical relief from structural inflation risks. Next, Jeff Christian reveals why slowing growth and stubborn inflation may reinforce each other rather than cancel out.
Interest rates are probably going to stay high in the United States and elsewhere. So you've got an environment that is going to probably grow increasingly more hostile in the final 4 months of this year into 2027.
Right. And so if the war continues, Jeff, would that mean higher energy prices, higher oil prices? And if that's the case, so we have seen what happened to precious metals when the war started. And some people say that that's likely because, well, countries needed liquidity, they needed cash, so they had to sell gold. So if energy prices goes higher, could that be negative for gold for a certain period of time?
It could be negative for gold. I'm not quite sure that it would be. First off, higher oil prices mean higher revenues for oil exporting nations if they're able to export their oil. And a lot of those countries, I mean, the oil is primarily paid for, as is natural gas, with US dollars. So there's this petrodollar sterilization that kicks in, which we saw in the 1970s and we saw it in the Audis. And you'll have a proclivity of oil exporting nations to try to sterilize or reduce their US dollar holdings by buying other currencies and also by buying gold and possibly also buying silver on a non-monetary basis, but on a financial basis. So the idea of higher oil prices could actually be positive for gold. The negative is that when you have higher oil prices, corporations, governments have to spend more money on petroleum and natural gas, and that reduces their revenues that they can use to buy other things. So that can further weaken the economy and reduce demand for what's really a discretionary investment purchase, gold.
Higher oil prices don't automatically hurt gold, even though that remains the popular assumption during geopolitical shocks. According to Jeff Christian, stronger energy revenues can encourage exporting nations to diversify dollar holdings into alternative reserve assets, including gold. That institutional flow often receives less attention than short-term retail selling. Investors watching only daily price moves may overlook the larger monetary rotation underway. Next, Jeff Christian exposes the overlooked relationship between petrodollars and precious metals demand.
And if we look, Jeff, at the big picture, so, we can see some similarities to 2011, and people are getting a little bit worried that we can see something similar to what we've seen back then. Do you see many differences, and do you believe precious metal bull market is still intact?
I think that, we take a long view. And, what we say is that over the last 26 years, you've seen an upward shift in the investment demand curve for gold and for silver. And you've seen an upward shift in the central bank demand for gold. And it's been relatively persistent throughout that period. Now, there's been some cyclicality. So you had prices, gold was $250 in 2000, and silver was $3.5, $4.5 an ounce. So you saw a period of time where the gold and silver prices rose very sharply. And we had very bad economic and political and financial conditions 2007 into 2011. And that caused the prices to rise very high. Things got marginally better after 2011, but they didn't really get fabulously better. And we're still in this very hostile economic and political environment. So gold prices fell down. They consolidated between 2013 and 2019. And now they're rising again in a way very similar to the increase that we saw from 2002 into 2011. And we think that there's further to go on that. There could be a situation where things improve, but we look at U.S. domestic political problems. We look at U.S. and global international political problems. And we look at the economic conditions and the financial markets and the overvalued U.S. stock market and the asymmetry between a few very speculative companies in AI and crypto that have been pushing the indices higher.
History rarely repeats perfectly, but investor behavior often follows familiar patterns during periods of uncertainty. What Jeff Christian is highlighting is that long-term demand trends for gold have strengthened despite multiple corrections over 2 decades. That persistence challenges the belief every pullback marks the end of the bull market. Investors focused on structural demand may see opportunity where short-term traders see fear. Next, Jeff Christian unravels why today's stock market strength may be masking deeper economic weakness.
While the majority of companies are not doing that well, so you have a stock market that on an index basis looks good, but then when you start looking at companies that actually produce and supply goods and services to people, they're not doing so well. So you have a lot of economic and political and financial and social problems that we don't see an easy solution for. If you saw some reduction in those problems, you could see gold and silver prices come off.
Headline indices can hide weakness when only a handful of companies carry the entire market higher. Jeff Christian's argument suggests investors should look beneath index performance and evaluate the broader economy supporting corporate earnings. That gap between perception and reality often widens before major market adjustments. Preserving wealth requires following fundamentals instead of celebrating benchmark records.